Volatility is a natural part of investing, and getting used to those up and downs. It doesn't mean you've done anything wrong. You're not the only one that's experiencing it. Even really experienced managers in charge of these big funds are seeing the ups and downs in the market. So it's not just affecting you, it's just the way the markets work.
This episode is sponsored by Saxo Markets. Hello and welcome to the Investing Insiders podcast, where we help you achieve financial well-being by making smarter money decisions. I'm Brianne, and in this episode, we'll be digging into how you can maximize your stocks and shares ISA and improve your investment returns. Joining us today is Lauren Gradys, Investments Product Manager at Lloyds Bank. Lauren, thank you so much for joining us today.
Thank you.
So we're going to be digging into stocks and shares ISAs and how people can use those to take their first steps into investing and hopefully generate a return too. Before we actually get, into the nuts and bolts of it all, could you kind of give us a brief overview of how stocks and shares ISAs work and how they differ from, say, a cash ISA?
Yeah, of course. So stocks and shares ISA, it's an account where you can hold investments, and inside that account, those investments are protected from tax. So you can invest in things like funds, shares, bonds, and inside, none of the growth is taxed. So it's free from capital gains tax. Any income from things like bonds you get, there's no income tax, and any dividends you receive, there's no dividend tax on those either. So you keep in full whatever you earn from income or from growth in your stocks and shares ISA. And that differs from a cash ISA. So in a cash ISA, you'll put your cash, you'll gain interest on that cash, and then you won't pay tax on the interest that you receive. Generally, investment ISAs are good for sort of longer term growth. Cash ISAs are good for the shorter term savings or emergency funds that you might have. And you can currently put up to £20,000 in your ISAs in the current tax year.
Amazing. And are there any differences in between what affects the amount of growth you can get? So with an investment ISA, are there any sort of risks or anything like that that could also affect your return?
Yeah. So if we look at the benefits of investing, the investing tends to grow more than cash does over time. Historically, we've seen it beat cash returns, and it tends to be inflation over time too. But if we look at the risk side, you also have these ups and downs that you experience with investments. That's a natural part of investing. And I think the key risk you need to be aware of when you're using an investment ISA is needing your money at a point where a market is on a downturn. So if you need your money at that point, you might have to sell your investments, and then you end up with less than you had originally, and you don't get back as much as you invested. So I think the key risk to anybody investing is needing that money at a point where the market is at one of those low points.
Yeah, I think that's such a really important point. And I guess picking up on something you said earlier in terms of the time frame between, say, using a stocks and shares ISA versus a cash ISA, what types of lengths of time should people be looking at for both?
Generally speaking, for something like an investment ISA, you would look at maybe goals that are 5 years or more away. It just gives your investments that time to grow, especially as markets go up and down along their way. And with a cash ISA, sort of anything less than that would potentially be better in cash.
Yeah, so I think with investing, one of the things that has always been quite interesting is the difference in returns. So potentially there is the opportunity to really turbocharge what's in there and beat inflation. Based on the sort of returns aspect, are there any situations where people might actually be better off saving rather than pursuing investing?
Yeah, there are a few different situations because investing isn't right for all money sort of all of the time. So if you think about your short-term goals, so as we've just said, so anything sort of in the nearer term, less than 5 years away, might be better in cash because markets can be volatile and they take that time to smooth out. Emergency funds, anything that you're going to need immediately, same day, tomorrow, anything that you need to get your hands on quickly is better as easy access. And also a third scenario is when you have been investing and you've reached what your goal might be, and just moving that money over into cash to sort of preserve the amount that you've got before you make the payment towards whatever your money was for as a part of sort of de-risking might be an idea. So those three sort of scenarios where you may be better looking at cash.
That's really interesting to know. And I suppose for anybody that maybe is looking to take the step into investing, what's a good way to know whether or not they're kind of being held back by sort of fears around investing versus actually maybe you should wait, or maybe you should, consider something else with your money for now?
It's probably looking at the time horizon that you've got for your goal. And if you have that longer period of time, then investing is worth having a look at. And there are some really simple ways to get started to sort of overcome some of those fears, because I think people think, oh, I need to be an expert. And there's some ready-made portfolios, for example, where experts have picked those investments for you, or people think, oh, I need loads of money to get started, and that sort of becomes a barrier to investing, where investing is actually a lot more accessible these days, and you just do need sort of small amounts, and you can build those pots gradually over time and build your confidence with those small amounts too.
Yeah, I think that the confidence side of things is such a key part of what can hold people back sometimes. There's obviously a lot of research out there which kind of shows the different examples and environments in which people don't necessarily feel empowered to take that step. So when you're kind of looking, I suppose, to think about opening a stocks and shares ISA, looking for a platform, what are some of those key parts of a provider that you should use to kind of compare and contrast and try and find something that suits you?
I guess if first of all we take the sort of fees aspect. So generally speaking, there are sort of three main fees involved with investing. So platform fees, which are your account fees, and they are for things like the admin on your account, the tech that platform uses to help you invest, the customer service kind of aspect. That can be a percentage or it can be a flat fee. Flat fees are generally better for sort of larger amounts. Percentage-based fees are better for sort of smaller amounts. You might want to look at the trading fees as well. Those are the fees to buy and sell investments. They're generally more relevant for those customers who are buying and selling constantly, because those fees can add up over time. Less sort of relevant for those buy and hold investors. And then other fees are the investment charges for the funds or investments that you have in your account. So things like funds or exchange traded funds will have a fund manager in there managing those investments, and they generally have an ongoing charge associated with it, and that's a charge for managing the fund, day-to-day running of the fund, and the research in there. So there's the fee side to have a think about, but also what is the range of assets that your provider has. So some providers have a limited range and have less sort of account fees associated with that, or some platforms have a wider range of fees. You might want to think about the range of products that are available. So whether you want to invest in an ISA, whether you've used your ISA allowance, use a general investment account, you might want to use a pension on the platform, and then looking at the range of assets that are offered. Some providers have a shorter range of assets than others. If you want to invest in investment trusts, exchange traded funds, lots of different international shares, it's worth just checking that your provider provides all of the different assets that you're interested in.
Amazing. And I think we did touch on this earlier in terms of how long ideally, someone should look to keep their money within a stocks and shares ISA. So, maybe around 5 years, give or take. Is there, what kind of time frame is there to kind of leave your money there? Because I think sometimes with investing, if you have the idea, you want to put it in for 5 years, what kind of happens next? Especially if you don't necessarily have a solid goal in mind, say purchasing something or maybe funding a trip or something like that. At what point in time do you kind of think, okay, it's time to have a look again, see how things are going, and take that next step?
Yeah, I think that's an interesting one. I think set and forget is the mindset, isn't it? So it's kind of leaving it there for the longer term to grow. And I think when you're new to investing, it's generally, I don't know, quite tempting to go and look at it daily. I think people get a little bit carried away and look at it constantly. But I think it's right, like you say, to sort of leave it to build over time, because the markets do go up and down. So sometimes it will rise, sometimes it will fall. And I think maybe checking your portfolio once or twice a year, maybe quarterly at a push, is probably the right thing to do, because I think the more that you check it, the more you tend to make emotional decisions based on what's happening at the market at that time. I think it's really important to check your portfolio intentionally rather than by accident. So give it a bit of a review to check whether your goals have changed. Are you still wanting to have a goal that's sort of 5 years more out, or do you want to look to move some of that money into cash, or do you want to put more into investing? Has your time horizon changed? Is it further out now? And has your risk tolerance changed? Have some of those bumps been a little bit too much for you, and you might want to sort of de-risk into less risky investments? Or actually, are you not seeing the growth that you'd like to? Has your time horizon lengthened? Do you want to take on a little bit more risk? So it's about having that intentional check-in and checking that your goals are still the same within your plan.
I think that's so key, because as with all things in life, there's change and things aren't necessarily fixed. And I really like what you said about sort of thinking about sort of the greater context of how things are going. Have you had any financial shocks that might make you, need to reevaluate how much you're putting in or how things are looking? When it comes to sort of doing those check-ins, how important is it to maybe get professional financial advice? Is it something that people can sort of try by themselves to see how it goes? If somebody was weighing up the balance between those two things, what should they take into consideration?
I guess it's how much confidence you have. And I think if you are deciding whether that's the right thing for you, it might be worth having a chat with a financial advisor just to check that you're on the right lines. But generally speaking, the things I mentioned are the things you might want to check for. But definitely, if you are uncertain, speaking to a financial advisor is the right way to go.
Yeah, it's all about building that confidence and just making sure it's as tailored, I suppose, to your circumstances as possible. And I suppose before people even sort of take that first step, are there any checks and balances that they need to do before jumping into the world of investing? What kind of signals that somebody might be ready to take that step if they want to?
Yeah, I think there's a number of things that you can definitely do before taking that first step. And a lot of it is doing sort of that upfront thinking before you take the first step. So, I mean, we've mentioned having that safety net in place, having that emergency fund in place, and that should be around 3 to 6 months of your income. And really the reason for that pot there is to stop you having to go into your investments and take money out at a point where the market might be on one of those downturns. So having that money there for your short-term goals, for your emergency fund, means that you have a lot less risk of dipping into investments and you can just leave them to grow over time. I think making sure you know what you're investing for, and it may just be to build wealth over time, and give it that time frame. How long a time frame do you want to invest for? And then really accepting that volatility is a part of this. So getting yourself used to the fact that you're going to see your portfolio go up and down. Markets and investments aren't linear. That's the way they work. Cash, you look at it grows, it's quite safe. You see it going up in incremental amounts, whereas with investing, it is, it does bob around. It's not a linear journey that you're on. So making sure that you're okay and you're comfortable with that. And at the same time, having a look at your attitude to risk. And by that we mean a look at volatility. So how comfortable are you with those ups and downs? Because a less risky investment will give you less ups and downs, I guess, sort of less accentuated ups and downs. Whereas a more risky investment, there will be bigger ups and downs that you will need to be okay with on your investment journey. And I think if you get your balance of risk right, you have less chance of wanting to come out of the investment. And then having a think about how hands-on you want to be. We talked about ready-made portfolios where an investment expert will create an investment for you. You decide what risk level you want to take, whether that's low, medium or high, and you can get on with it, go from there. You don't have to pick and choose your investments. And the alternative to that is looking after maybe a full-on stocks and shares ISA where you pick and choose your own investments. You're a bit more hands-on, maybe you have more time to research and you want a little bit more control. And just accept that you're going to learn as you go and you can adjust things.
Yeah, I think that's such a really important point to highlight, the fact that you can make changes. So it's not like if you get into, a certain ready-made portfolio or certain fund and you're not necessarily comfortable with the, intensity of the highs and lows based on the risk portfolio that you've chosen, there are ways to make changes and adjust it and make sure that you find something that you're comfortable with that keeps you on track for your sort of long-term goals. I think sometimes it can feel quite overwhelming, the thought of seeing those spikes and dips in money and trying to kind of get comfortable with that. So I think one thing that it will be great to kind of touch on is, and we spoke about this a little bit earlier, obviously it's great to have an emergency fund before you get going of around 3 to 6 months worth of expenses. For anybody that thinks beyond that you need a certain amount of money to put in to invest, is that true? Like, how true is it that you actually need to have like a, fixed amount before you can get started?
No, and I think we think that, don't we? And I think we sort of say, oh, I'll start investing when I get to this amount. I'll start investing when I get my next pay increase. And actually investing is a lot more accessible now than it has ever been. I think what you said about getting your emergency pot ready, that's, putting the foundations in place before you start investing is super, super important. But then once it comes to investing, no, you don't need that much. So if you think about something like ready-made investments, you could use £50 a month, for example. If you're managing your own stocks and shares ISA, it could be less than that you put in. And starting small, I think, means that you develop those good habits and you can keep it going and build over time. And I think starting small allows you to build that confidence and discipline, which is so important for when you're investing.
It is. The power of compounding is something that we try to highlight quite often, because it might seem like something is a really, really small contribution, but when you kind of commit to that regularly, even if it's say like, £20 a month or something like that, it's going to build over time. And just giving it that opportunity to, grow and then look back and see, wow, that's made a big impact is really important.
It is. It's that snowball effect that starts over time and kind of accelerates, doesn't it? So those small amounts really do pay off.
This episode of the Investing Insiders podcast is sponsored by Saxo Markets. Saxo provides access to a broad range of global assets through a sophisticated trading platform. You can trade US stocks from as little as $1 per trade and UK stocks from $3 per trade. Please remember that all investing involves risk. The value of your investments can go down as well as up, and you could get back less than you invest. Terms and conditions apply. Visit Saxo Markets to learn more. I suppose looking at volatility, so the value of your investments going up and down over time, at the moment, we are seeing a lot of that in terms of, conflicts that are going on in the Middle East and lots of market changes. What can people do to make sure that they don't panic when things like this happen? Because I'd say, over the last 6 years especially, we've had so much turbulence. There's been a lot of market shocks, a lot of changes, and a lot of that's outside of our control. So is there anything or any steps that we could take to not panic in those moments? And what can we put in place to kind of measure whether or not we need to make changes or wait it out and see what happens?
I guess one of the key things that I think people need to understand is that the volatility isn't just happening to them. I think, especially if you're a new investor, I think you perhaps think, oh no, this is just happening to me. My investments have gone down. I must have done something wrong. I now need to rectify it. I now need to come out of that. But I think, as we were saying sort of before, volatility is a natural part of investing and getting used to those up and downs. It doesn't mean you've done anything wrong. You're not the only one that's experiencing it. Even really experienced managers in charge of these big funds are seeing the ups and downs in the market. So it's not just affecting you, it's just the way the markets work. Sometimes it's more accentuated than others. And like you said, don't panic and don't rush to act, because generally speaking, because the market experiences this a lot, better outcomes can be when you stay invested. And if you stay invested, you can take advantage of any recovery that might come as the markets sort of regain their course. A point on sort of history. We've seen volatility like this as a result of conflicts before, or as a result of the pandemic, as a result of recession. And historically speaking, the markets have fallen, they've recovered, and then they've continued on their way. So if you rush to sell out, it may mean that you're not able to take part in any recovery that does take place. I think it's a really good point to check your diversification, because if you've experienced super volatile times, then potentially you might want to have a look at how diversified you are. And I think if we look at some ways you can diversify, it's not putting all your eggs in one basket, isn't it? It's instead of one company, it's going for a few companies, because when some companies struggle, others will grow in certain times. Looking at different countries, because as some countries slow down as a result of market events, others will expand. Looking to different sectors. So the tech sector will work differently to the mining sector, will work differently to healthcare. Spreading your money over different areas will increase your chance of sort of weathering those ups and downs. And equally, different assets, shares will react differently to bonds, will react differently to funds. So making sure you're sort of smoothing your money over different areas like that, as some parts of your portfolio will be affected, others will buoy it up at the same time. And let's not forget that volatility, when it drives the market lower, does become an opportunity. So it's not all bad news. There are ways to get into new investments that you might not have thought about, and those prices are lower, so they provide you with the opportunities to do that.
Absolutely. I think having the lens of opportunity on, particularly with finances, is so important. And it's interesting where what might seem like a downturn and a loss could actually turn into something that builds and regains for the future as well. I think one of the things that's really interesting about investing is obviously how linked it is to the wider world and things that are going on. For people that might want to take a step outside of, say, a ready-made portfolio where everything is decided, what's the best way to stay in contact with what's going on and how that affects, say, any funds that they might have, or shares, or the value of their investments in general?
Yeah, so the investment platforms that you're with, I know that we send out regular sort of email updates to tell customers what has been happening in the market and what might be going on in the market going forward. And we also tend to send information out about what sort of themes might be looking to be opportunities in the future. It's always good to keep a look at the performance of your investments in research centres. You can find out what's going on in the news and the markets on those, and keep a well-rounded view of everything that's going on.
Yeah, that's great. And it kind of just helps make sure that you're not left alone to kind of figure everything out. Like, having those market updates is so important, and it really does make a difference. I think another thing based on portfolios, and I know that we touched on this earlier in terms of maybe checking 2 times a year, is there, for people that kind of feel a bit anxious about performance and might have the tendency to want to know what's going on all the time, is there sort of a limit to how much, or how often they check their performance? Like, how much is too much?
I think it's quite tricky these days, because you have everything in your app, don't you, ready at your fingertips, and you can see it constantly. And it's up to you how much you check. I think the real important part is to not make any decisions based on an emotional reaction. Keep a plan, know how long you'd like to invest for, and stick to that plan. And if nothing's changed in your plan, checking your investments daily and sort of being affected by the ups and downs that you see in the market shouldn't affect your longer term plan, and always think longer term, I guess, is the message.
Yes, definitely. And some of the things that do come up, particularly with newer platforms, or if people are looking to switch from one platform to another, are transfer deals. So you might be able to earn, say, cashback or rewards from moving from one provider to another. What are some of the sort of benchmarks people should keep in mind to make sure that they're getting value, and how much attention, should you really pay to big cashback offers? Is it better to kind of, stick with a provider rather than moving around too much?
I think it's what works for you and what value you are going to get from the platform. I think we touched on before, the range of assets that are offered needs to match what you would like, whether you're a new investor and you're looking for those ready-made portfolios, whether you're looking for a pension investment, whether you're looking for a stocks and shares ISA. I think the credibility of the provider and the reputation of the provider is something that's really, really important as well. Making sure that the FSCX protection is in place as well, and generally making sure that the tech that the platform provides is what you'd like it to be. Have a look at the research centre. Does it give you all the information, all the investments that you want to invest in? How many updates do they give you on the opportunities in the marketplace? Have they got an app? Do they offer regular investing? And then overall, what are the overall charges and fees that you've got for your account? And are you receiving value for that money?
Yeah, that raises a really important point about the FSCS protection, which is the Financial Services Compensation Scheme. And that offers up to 85,000 for investments if the provider goes bust. Another thing that kind of leads on from that is trying to make sure that you avoid investment scams. So that could be potentially signing up to a platform that isn't regulated by our financial watchdog, which isn't regulated by our financial watchdog, which is the FCA. What are some of the steps that people can do to make sure that the platforms that they use are regulated, and also to avoid any, too good to be true opportunities, which are actually just fraudulent schemes?
Yeah, you can check that your provider is registered on the FCA website, and it's always worth going with a credible provider. A lot of providers have been going for years and years and have a lot of experience in investments. So if you're unsure about anything, going to one of those providers is generally a good idea. If you're receiving any emails about new investments that are claiming to be too good to be true, usually it is too good to be true. If there's any sense of urgency in there, any asking for your bank details, you need to make sure that you're checking with your provider or the provider that it's come from, that this is genuinely a truthful email.
Yeah, I think that kind of goes into all of the sort of housekeeping, and just making sure that everything is along the right lines. And I suppose for anybody that is unsure about a platform, the best thing to do is ask rather than act.
Yeah, exactly that. Get in touch with the provider, have a conversation with them using the telephone numbers that are on their credible website, rather than anything that you're getting through on any comms, be there text messages or emails, and just making sure that information is truthful.
Perfect. And I suppose in terms of just having that kind of investing checklist, are there sort of any tips that you wish people kind of had in place to sort of help them know when they're ready to get started and, be on their way with their investment journey?
I think when I've thought about this, the one tip that I would give people is to automate your investing. I think that setting up a regular investment plan when you start investing, deciding how much you want to invest and what you're going to invest in, and then letting that run in the background is a really good way to start investing. Not only does it help you build the habit, it keeps that consistency, it keeps the discipline which you need in place to build over time. And it takes advantage of the pound cost averaging that we were talking about earlier, buying more investments when prices are low. less investments when prices are high, and that price evens itself out over time. And it means that you don't have to make any sort of timing decisions. It does all that for you. And I think my favourite part about it is it takes the emotion out of investing. The worry about when to buy is totally removed because it's all done for you in the background, and you don't have to remember to do it because it's all just running there for you. And like we were saying, the small amounts do build up over time.
Well, Lauren, thank you so much for joining us for this episode. It was amazing talking to you. And I think these are some really great tips for potential investors and people hoping to kind of rework their strategy as well.
Well, thank you so much for having me.
Thank you so much for joining our Investing Insiders podcast. If you like the episode, please subscribe and leave us a 5-star review on your platform of choice. For the latest money news and deals, you can sign up to our weekly newsletter at investinginsiders.co.uk/newsletter-page. We've also got a suite of guides, tools, and calculators on our website at investinginsiders.co.uk. You can also keep up to date with us on TikTok, Instagram, and YouTube. Thanks for joining us, and we'll catch you in the next episode.